Hi, welcome back, everybody. This is Brian Neal again with Tradetobefree.com and InvestBeFree.com, and this is a swing trading beginners course. It's also great for more advanced swing traders who are learning our strategies. This video, number 5, is all about one of the top swing trading patterns in the market, and it's a continuation pattern. It's called the earnings flag, and it's a very, very good trading setup to learn and use on a simulator if you're new. And a lot of great traders out there will get really excited about earnings flags if they're very strong and very well developed on very good stocks. So this is a great video to put a new swing trading pattern into your arsenal that has a really good success rate and is one that's used by top traders. But first I want to talk about what we've covered so far. And what we've covered so far is why swing trading is so important and how it has the potential to really upgrade your lifestyle by earning a higher rate of return on your aggressive portfolio. And I do mean earn in the sense that you're going to have to learn how to swing trade, technical analysis, and practice and learn over time to become very good over time. Okay, but I showed just one of the strategies that we teach, more passive strategy on InvestBeFree.com, and showed how before fees and commissions it was able to achieve 42% per year on average over a 5-year period, and how that kind of return really explodes your account, your aggressive portfolio over time versus making just a market return. So we're really after a market beating return for the long term. And if we do that over 5-10 years, if you're able to achieve 40% per year, as an example, that will multiply your account by around 35 times, I believe, over a 10-year period, which would take $30,000 to $1 million over that time frame. So that's the power of making a higher rate of return and why people care about swing trading and learn these strategies and learn how to use them really well. Now, if you just put that money in the overall market and make 7-8% per year, which is pretty common if the market does pretty well, then you're talking taking $30,000 and turning into, I think it's around $70,000 or $80,000 over 10 years. So, $1 million versus $70,000 or $80,000, and you have to ask yourself, where do you want to be in 5-10 years? Do you want to be, where you are now, or do you want to be in a totally different place financially? And if the answer is you want to be in a different place, then swing trading is a great way to go after that higher rate of return that you need in your aggressive portfolio. And one of the great things about swing trading and aggressive strategies like this is that you don't have to use an entire account or entire savings to make a big difference over time. You can start with just a small portion of your overall portfolio, and as you save money, you can put most of your money in safe investments and then put a small portion into a more aggressive portfolio and aggressive strategies such as this. And if you do achieve that rate of return consistently over a long period of time, you'll be in a very good place 5-10 years down the road. Okay? And we also talked about how you don't need to give up your career to swing trade. This is not day trading where you have to, watch the stocks between 9 and 11 or 9:30 and 11 a.m. every day or throughout the day, okay, and give up your day job. You don't have to do that with swing trading. At least with our strategies, you can put market orders in to buy and sell after the market close, and those trades will execute when the market opens the next day. So you don't have to give up your day job, risk everything to get started with swing trading. And again, a lot of the things you learn when you swing trade can be applied to day trading as well, including candlestick analysis and chart patterns and trend analysis and other things you need to really know and master to an extent to do well swing trading. All right, we talked about also risk management and how that's the number one thing to learn at first. And we have a whole video on that. So if you haven't seen that yet, go back to that video. And I believe it's video number 2 or 3. And also learn candlestick charting, chart patterns, trend analysis, support and resistance, and the importance of key moving averages. And those are fairly simple once you start learning them and once you spend the time to understand what that is. And I'm going to teach you most of what you need to know in this course, and it's going to really help you a lot to get started swing trading and becoming successful. Okay, we talked about the hardware software needed for swing trading versus day trading, and how swing trading you don't really need much in terms of upgraded software and hardware. You don't need multiple monitors. You don't need to train for 6 months to a year. on a new platform. You don't have to spend all that money up front to learn swing trading and start to become successful. Okay, and we also talked about the general process of becoming a very good swing trader, and this also applies to day trading. And basically what that is to identify and then learn a great technical setup. And I would argue only on the best stocks, as we do on Tradetobefree.com, but you want to learn a great setup, a technical pattern, okay, that may involve news items too, and a catalyst, okay. You want to practice that setup until you're consistent, all right, and we're going to talk about one of those setups here, the earnings flag here later in the video, but I just want to review this because it's so important. And once we practice trade the setup, we want to start trading that on a live account. As we practice trade, we learn and we fine-tune the strategy. Once we're confident with it, we move to a live account. We start small, all right, and then we continue to review the trades and correct errors. And then once we have enough confidence, we scale up and we go after the bigger gains and the bigger profits over time. And that's how we learn to be a successful swing trader. Okay, it takes discipline, it takes effort on your part and practice. The payoff, though, is there in the end. Okay, and we also talked about how choosing stocks with rapidly improving fundamentals will give us a slight edge over other traders in the market when trading the best technical patterns. And I've tested dozens of strategies. Ton online over time, and they almost all work a little better on strong growth stocks and BTE stocks. BTE means better than expected. Those companies that are beating estimates with rising future expectations. And it also even gives you a slight edge when day trading, all else being equal. So if we get a list first of stocks that are top growth stocks and stocks that are beating expectations with rising future estimates, we have a slight edge over the rest of the market. Okay, and we also, when we talked about risk management, we talked about how lower price stocks tend to be more risky. And the fact that because a stock is trading at $1 or $2 or $3 doesn't mean it's going to be worth more than $3 or $2 a year from now or 2 years from now. In fact, it's very likely to be worth around that much or less because stocks under $10 tend to stay under $10. In fact, the vast majority will stay under $10 and really go nowhere over time. They may have more volatility, and some traders trade those stocks under $10 and can do well, but they're much more difficult to trade, less reliable, and again, they're going to stay under $10 probably for the long term. Now, a few of those stocks under $10 do have the very best fundamental factors, a very few of those, but they still tend to be more risky, and oftentimes they have lower volume and a wider bid-ask spread, and they'll just tend to have less reliability and more risk than trading stocks over $20. That in some cases will make big moves using our swing trading strategies. So if we pick the right stocks in the right industries, in the right technical patterns, we're far better off with stocks over $20 than stocks under $20. And another thing I want to point out too is that if you trade stocks over $20, to scale up to a large account, it's very easy to do. Now, if you trade stocks under $10 and you go from a $10,000 account up to taking $50,000 positions or $100,000 positions down the road as your account grows, you're going to find it very, very difficult to scale up to making more money in the market. And you don't want to go down a dead-end road where you're capped at the amount of money you can make on each trade, just because the stocks that you trade are under $10, and if you buy 10,000 shares or 20,000 shares, you push the stock up 2, 3, 4% or more just by entering the trade, and there goes your profits. When your average profits are only a few percent when you trade those stocks. So that's another advantage of trading stocks over $20 is that you can scale this strategy to larger account sizes, and I'm going to show you that here in a minute with a great example. And whether you're trading $1,000 or $2,000 per position, or whether you're trading $200,000 per position, which you want to get to at some point, you'll be able to make the same amount of money per trade percentage-wise, which is very important over time. Okay, so now we're going to get to the good stuff. This is the first trading setup I want to teach you, and it's called the earnings flag. Okay, and it's, again, a favorite of top swing traders. Okay, the earnings flag is basically a big move higher after an earnings release, followed by a sideways to lower consolidation, and then a breakout. And when I say a breakout, I mean either a breaking of the short-term downtrend in the flag, which I'm going to explain to you in a second, or a move above the top of the flag. Now, we also trade the actual earnings event in what we call the earnings eruption trade, and that's more of a day trade, okay? And it's also one of the highest performing day trading setups. And during a recent earnings season, this setup was about 90% successful. And I've tested dozens of other day trading strategies over time on over 5,000 day trades in a live account over a two-year period. And for a day trade, the earnings eruption day trade was the highest performing trade by far. Okay, it's a trading setup that comes up maybe 5 to 10 times per month on average, more during earnings season and less outside of earnings season. Okay, but the stock has to pass several criteria, including being over $20 to have that kind of success rate. All right, and it often moves 3% to 15% within an hour or two, and that's pretty standard with that setup. And so, once we see that setup and once we trade it, then we look for the second setup, which is the earnings flag. Okay, and this is a swing trading course, so we'll be talking about how to profit after that initial big move, after a monster earnings release. This follow-up swing trade will help you capture big profits after the release, whether you work full-time or not. And even if you work full-time, you can actually take advantage of the earnings eruptions trade. You'll just have to use a buy stop order and watch the pre-market pattern before the market opens. But you can actually trade that pattern too if you work full-time. But this is easier. This swing trading pattern called the earnings flag is much easier to trade, and it's something you can more easily do with a full-time job. Okay, I'm going to show you exactly how to find these powerful setups. Okay, the first thing we want to do before we trade the setup is we want to qualify the market. During a market uptrend, which is actually most markets, we want to find long trading setups. Okay, so in general, we want to short during a downtrending market. All right, so if the market is moving higher over time, over the long term, and has been, then we want to stick with long trading setups. In other words, we want to buy and then sell higher. Okay, if the market is trending lower during a bear market, all right, or if it's just in a correction, we want to look more towards short setups, okay, or wait for the right time to go long again. All right, so that's the first thing we want to do, is to qualify the overall market to know if it's trending higher or not. All right, so we'll start with the basics, and what we'll do is we'll use a quick litmus test by looking at the 200-day and 50-day moving average of the overall market. All right, and to do that, we'll look at a stock chart, and I'm going to show you how to do that right now. And on our site, we have a more in-depth explanation of how to know when to go short, when to go long, and we'll talk about things such as the bullish confirmation and the bearish confirmation signal, which are very important to learn and use in your trading. We went bearish before all the steep sell-offs over the past 10, 12 years in our newsletter, using that technique. And you want to learn the classic signs that a market's about to go into a new downtrend, and whether you day trade or swing trade, whether those long trading setups will continue to work or whether they will likely not work in the near future. Okay, so after we verify we're in an uptrend and we should be going long, we now need to find stocks surging on an earnings beat. Okay, and we'll look at financial news sites, Seeking Alpha, or your broker platform to find news stories during earnings season about stocks that are soaring after an earnings release. We're trying to find those stocks that are beating by a wide margin, that are gapping higher pre-market with raised future guidance. All right, these stocks tend to form the earnings flag days or weeks later. All right, so I'm going to show you some examples. All right, so now I'm going to show you examples of what to do exactly here online and show you a great swing trading setup right now, and also one we traded a few months back. Okay, the first thing I want to show you is a site, example of a site where you can get earnings news. This is SeekingAlpha.com, and they've got an earnings tab here you can click on, and it will give you the latest earnings reports as they come out, okay? And then once you click on each earnings report, you can see if they beat or missed on earnings, okay? And if it was an earnings beat, if the information's available for the stock, if there's analysts following the stock enough to make a projection about how much they'll make this quarter versus how much they actually produced that quarter, they'll put that here in this snapshot earnings release, okay? and it'll tell you whether they beat or whether they missed in many cases. Okay, so that's one good place to go to get a list of companies as they report earnings that beat estimates and raise guidance. Okay, so a lot of times they'll put the guidance raise in the snapshot I just showed you, or it might be in another news story on the stock. You want to find companies that are beating by at least 20% on the bottom line, so they have a 20% or more earnings beat. Okay, and again, usually it'll say in the snapshot there, the news item, whether they beat or not and how much they beat by as a percentage. Very often they'll do that here in Seeking Alpha. Okay, but if they don't, you can calculate that pretty easily. You can also go to the Zacks earnings calendar and on Zacks.com, and you'll find that on the site. And after the earnings release comes out that day, they'll update that, and you'll see how much they beat by. And that's the one I use probably most often. And from there, I can actually go back a week, 2 weeks, 3 weeks, and get a list of companies that have beaten by a wide margin on the bottom line. And then I can dig down into the news stories to see which ones beat on the top line as well. So I want to see companies that beat on the bottom line, the top line. I'd say the bottom line by at least 20%, or 15 to 20%, I would say. And then also beat on the top line. And I use that to build a watch list. And when I build my watch list, I want to see those stocks in very good long-term uptrends where they're making higher lows and higher highs over time. Okay, so that's how we begin to build a watch list of stocks to see if they actually create an earnings flag. Okay, and to qualify the market, the current market conditions, what we want to do is look at the 50-day and the 200-day moving average. Okay, ideally we want to see the 50-day moving average and the 200-day moving average sloping upward. All right, now on this chart, I put on stockcharts.com, I put the 50-day and the 200-day moving average on the chart. Okay, down here below the chart, they have options to put the moving average overlays on the chart, and you can just choose simple moving average and plug in 50, and then another one you want to plug in 200, and the colors may be different on your chart. But on this chart, this orange line right here is a 200-day moving average, and the blue line is the 50-day, which is right here. Okay, so ideally we want to see the 50-day sloping higher. We want to see the 200-day moving higher as well. So we want to see this line sloping higher, not downward. Okay, and we want to see the current price of the S&P 500 above both the 50 and the 200-day moving average, with both sloping higher. Okay, it's okay if it's around the 50-day moving average or a little below. That's okay. If it's sloping higher, all right. If it starts to slope lower, then it gets a little more difficult to trade in that kind of market environment, especially if both the 50-day and the 200-day moving average are sloping lower, and the current price of the S&P 500, which is an index of the top 500 stocks in the market. Okay, if that current price for that is below the 200-day moving average and the 50, and those moving averages are sloping downward, then we're probably in a bear market, and we want to avoid most long strategies. Okay, so right now we can see that we're in good shape. We're above the 50, above the 200. They're sloping higher. We're in a nice uptrend over time, and the market conditions are good at this point. So, okay, so now I want to show you an example of an earnings flag on a chart. Okay, so here is our site. This is our subscription site. If you want a free trial of this, you can get it for 3 weeks. There's no credit card required. You just go to our site, plug in your name and email. As I record this, there's no credit card required for it. And you just go in here and you can actually see the stock when it was featured back in March. This is Coherent. This company had a big earnings beat, and I believe a guidance raise too, and it formed a very good earnings flag. Okay, and when you click on the chart on our site, the latest chart comes up. Okay, and you can see how the stock has done since then, what the price movement has been since featuring the company. Okay, and you can see this pattern right here is what we call a flag. Okay, it's kind of a sideways or a sideways to lower trend, in the price over a number of days or weeks. This line right here is called the downtrend resistance, okay? And so what this is a downtrend, a short-term downtrend within a longer-term uptrend. And this consolidation stops once it hits this line, or it has in the past, okay, forming this downtrend resistance. Now, for this to be a valid downtrend resistance, we want to see at least 3 touches, and after 3 touches and it hasn't breached that line, then it's confirmed, okay? Before it's confirmed, if we have just 2 touches, and it's not really confirmed and it doesn't mean a whole lot, okay? A lot of people think it does, but it really doesn't unless you've had 3 tests of that line, okay? In this case, we have. So we have a confirmed downtrend, short-term downtrend. This is the flag portion of the pattern. This would be the flagpole from here to here is a flagpole, okay? So you can see it looks like a flag in a chart, and that's why they call it an earnings flag, all right? And generally, I want to see this flag go for at least a few weeks, at least 4 to 5 weeks before it breaks out. And there's 2 breakouts on this pattern. One is just breaking the downtrend resistance, and again, it has to be confirmed with 3 touches where it's held 3 times. Here you can see it held. Here there's a test of it, and it held. And here was a test of it again, and it held. So in this case, we've got this uniform channel, okay, where we have this resistance that we can play off of. And the longer that channel goes without it being broken to the upside, the stronger the breakout tends to be, okay? That's one of the key things about technical analysis you should understand. Of course, a stock has to have the improving fundamentals and the ability to move a lot higher, okay? Either strong, consistent growth or just more money moving into the industry, or they're beating estimates with rising future expectations, or something has to be going on, and the stock really has to have a history of making large moves before this channel really picks my interest. And in this case, we've got a strong growth stock, a stock that has a history of beating estimates and a history of growth, okay? So that's key. And on our site, we only feature those stocks with rapidly improving fundamentals that are forming technical patterns like the earnings flag. So, but this is a good earnings flag. This is a very uniform, sort of non-volatile, tight consolidation, more horizontal than vertical. If it comes down sharply, okay, and the flag portion points downward too much, more than 45 degrees, I would say, then it's less reliable, and I would definitely look for maybe a double bottom pattern in that situation, but not this pattern so much, okay? And so we want to see more of a horizontal consolidation than a up and down, more sloped consolidation towards the downside, okay? So at this point, we can see that the price closes above the downtrend resistance in the flag, okay? And that's the entry point that we use. Okay, so what happens is you check the stock every day. Once the price, or if the price, closes above the short-term downtrend, because theoretically this could continue to go in this channel and actually sell off and close this gap here and come down a lot further, okay? So we definitely want to see confirmation that the trend is now going back to the upside, all right? And that's key. So the entry point is a close above this short-term downtrend resistance, which happens right here. So that's the entry point. Okay, and then once we have the entry point, we see that close above the short-term downtrend after hours, we just go ahead and put a market order in after hours, which will execute at the open the next day. So if we work full-time, we can just check the site every day and check the chart. Once it closes above this short-term downtrend, we can put a market order and do that anytime between 4 p.m. and 9:30 a.m. the next day. And, as we go off to work, it executes automatically. And then we can put a stop loss right below the prior high, or prior low, I should say, the prior low in the pattern, which is right here. So you can put a tight stop right here, just below 180. I would say about 0.5% below that point, okay? And then put a limit order for our target sell price shortly after we enter the trade, okay? So that's how we want to trade it. And as the trade evolves over the days and weeks ahead, we want to see it making higher lows and higher highs. If it's acting pretty well, then we want to go ahead and keep it. If it starts to, if it goes up quite a bit and then starts to come down very sharply and starts to trend lower and lower, then we might want to take it off, anticipating the break of the prior low. Okay, may want to do that, or just keep a stop loss order just below this prior low here. All right, and another stop loss point would be below this uptrend support. We also have a verified, confirmed uptrend support because we've touched this line down here, a line drawn connecting the lows more than 3 times, more than 3 points. So that's a confirmed uptrend. So we could wait until it closes below this uptrend support as well. Okay, so we have 2 ways of playing it. All right, but that's an example of a very good earnings flag. All right, and now I also want to show you another example from actually a recent newsletter that's actually still in play. It's actually really near a good entry point right now, although it's starting to move now that's broken out of the earnings flag. So here's an example. Here's the other example. This is Best Buy, and we played an earnings eruption trade on this, which was a very nice trade on Best Buy, and this had a lot of volume traded that day. It had over 30 million shares. Okay, and we traded the move from about, I think it was about 57, 58, around 58, I believe, up to 61, 62 that day. So it was about a 5-6% profit within a few hours on that earnings eruption trade. Met all the criteria in the new course, and it was a really great trade. And if you make that trade on a stock under $20 that trades, let's say, 1 million shares or 2 million shares, it's going to be very difficult to scale your trading up to a larger account size. As your account grows, it's going to be tough to make money off those trades because you're going to be buying so many shares in the trade, and that's going to create a lot of slippage. Okay, so you're going to end up buying at a much higher price and making a lot less on the trade. Now with Best Buy, on these stocks over $20 and millions of shares trading hands every day, whether you have a $2,000 account or whether you have a $2 million account, and say $1 million position in that trade, which is not uncommon, for some traders, if they stay diligent and they continue to use these techniques for a long period of time, and grow their account, they'll eventually get to that point. Off $2,000, 5% is $100, okay? But off $1 million, if you trade $1 million worth of Best Buy and make 5%, it's $50,000, okay? So you make $50,000 on that trade, but if you do that on a penny stock, it won't work out as well because you can have a lot of slippage and the stock could drop 5-10% very easily, very quickly, okay, on those type of stocks, whereas Best Buy, it's much less likely to do that, and it's a very low stress trade in this case when it met all the criteria in that earnings eruptions course that we have now on the site. So that's one of the great things about our techniques and strategies is that you can scale these to very large account sizes without, losing all the money and slippage, and without taking all that risk you take with a penny stock, where the stock can drop 5-10% in a blink of an eye. Okay, this trade in this stock, it's very unlikely to ever do that in that trading scenario. With all those factors that were in place at the time we made the trade, that would have been very unusual for a stock at that price level to make that kind of move that quickly, although it's very common for stocks under $10. Okay, so you have a much more reliable trade, it has a higher success rate, and you can scale it to large account sizes. So as your account grows, you can, instead of making, a few $100s per trade, you can make $10,000 a trade or $20,000 a trade or $30,000 a trade. You can just keep building it up over time as your account grows. So that's why you want to trade these techniques, and that's why you want to trade stocks, above $20 and learn how to do those, learn how to trade those stocks, because, you're going to hit a limit with the stocks under $10, and it's just a question of time before you get there. So that's why these strategies are much better to learn, and they're actually more reliable. On the earnings eruptions trade, for instance, the reliability is much higher, and last quarter it was nearly, actually over 90% on one of the back tests when all the criteria was met in our course. Okay, and then stocks under $20 will not have nearly as much reliability with a tight stop loss. You just won't find it. And if you let it go below the stop loss, they can go a lot further lower as well. So, that's why you want to learn these techniques and on these better quality stocks with rapidly improving fundamentals. Okay. So, but this is another example of a really good earnings flag. We played the earnings eruptions trade on the day of the earnings beat. Then we wait for the stock to pull back, consolidate, form the flag. If it does, and does it very well, then we look for that downtrend or that flag downtrend resistance to break. And we can see it did it here. We jumped in right as it was breaking out of this downtrend resistance. All right, and it's already up a few percent, like 5-10% already within 2-3 days as the market pulls back. Okay, so it's a very, very good trade. The earnings flag, it's for a new swing trader. It's definitely one you want to look for. And again, it's all about qualifying the current market conditions first, finding the companies that are beating estimates, that have growth and a long-term uptrend, and form a good flag pattern. In this case, the flag portion of the pattern kind of came down. It kind of curled over here a little bit. So that's not as good as a more uniform trend lower, but it still was pretty good. And looking at the fundamentals of the company and the high dividend and the current market conditions that we're in, we would be a very good trading setup if it broke out of this short-term downtrend here. Now, there's also another entry point on this earnings flag, and that is above, if it closes above the top of the flagpole. So here we can see, the flagpole, the flag portion of the pattern here. Okay, if it goes above the flagpole and closes above the flagpole, that's another good entry point. So what you can do is see if it closes above that flagpole, and then either enter once you know it's going to close above the flagpole, or you could put a buy stop order just above that day's high the next day for the next day. Okay, so if it closes above the flagpole up here, let's say, and the next day it starts going above the prior day's high, that's another good entry point. And especially if it does so with a lot of volume. We want to see, if we wait to that point, we want to see the price move above here and close above with about as much volume, close to as much volume or more than what took it into the flag pattern on the day of the earnings beat. Okay, so we want to see a big breakout and strong volume, similar to what we saw here. Okay, to continue that trend higher. Okay, so that's another good entry point on that. And one thing you can do is on this trade, if you get in here, you can sell some as it reaches this point, just a little below the top of the flag. Okay, if it goes through there with a lot of volume, we can add to the position and add more shares and just ride it higher as it goes through the top of the flag. We can do that too. Or if it's not looking quite that strong, like right now, it's looking pretty strong, but we'll take some off, quite a bit off here near this top of this flag, and then keep the rest until it closes, let's say, below the 20-day moving average, and then closes then moves below that point, and then we might wait for it to close below the 20-day moving average or the 20 EMA. And I'll bring that up here on another chart here. And let me change the settings so you can see it better. But on this chart, we have the 20 EMA, which is the green line. So we can wait for this price to close below the 20 EMA. First of all, stop it at your entry point. But then, for our final shares, that we keep after the first, targets reached up here, just below here. Okay. So around 61.40, let's say, we can keep the rest of our shares until it closes below the 20 EMA and then moves below that day's low the next day. Okay, because oftentimes once you get that close below 20 EMA, you often get one more rally into new highs and one more leg higher before it comes down and goes into a new consolidation and trends lower for a while. Okay, so you often get one more push and you can sell the final shares into that next rally as it breaks new highs again. So that's the earnings flag. It's a great trading setup. You definitely want to watch for these in your own trading. We have a lot of these on our site throughout the year. Again, there's that free trial. You can go to our site and try it out free for 3 weeks, and you'll find these in the list of trading setups. Sometimes you have to be patient. They don't come up, every day, but I would say every week or two, you'll see these breaking out, and it's a great swing trading setup to trade. Thanks for watching today. If you liked the video, give it a thumbs up below, and be sure to tap my image here to get notified when our next video is published. And if you haven't yet, tap here to get our top 2 trading opportunities for the coming week emailed to you. Stocks with the right technicals and fundamentals to make a big move higher. And if you want to learn one of my best strategies, tap here and you can learn how to do it yourself.